Hello and welcome to today's episode of Nucleus Investment Insights. Today we're going to talk about behavioral finance and the psychology of investing. Then we'll discuss the question on many people's minds, which is, are we close to the market bottom? As always, we have Damien Klassen, who's Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hi, Sam.
Thanks, Damo. We also have a special guest today, Evan Lucas, who's head of strategy at InvestSmart Group and the author of the new book, Mind Over Money. Evan, welcome.
Thanks for having me, Sam. Hello, Damo. How are you? Nice to meet both of you. This is going to be great fun. I really love these kind of events, so it's always good to sit here and talk to people with like-minded and talk about subjects that are really close to my heart.
Excellent. Nice one. So my name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. On the agenda today, we're going to discuss Evan's new book, Mind Over Money, and the psychology of investing. Then we'll talk about the market in the context of the question, are we close to the market bottom? And within this, we'll touch on asset allocation, stock selection, Australian securities versus international securities, inflation, US company results. Then, as always, throughout, we're going to discuss the investment implications. Just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. We are live every Thursday at 12:30 Australian Eastern Standard Time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do the best to answer them during the show. You can also follow us on your preferred podcast platform as our show is available on all the majors. And as always, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got those formalities out of the way, I'll hand over to you, Damo, just to lead us away, give us some context and to get us started.
Yeah, sure. So we've dragged Lucas on today because he's got a book out, Mind Over Money, which sort of covers off on a number of things, obviously, that we're sort of pitching to people as well about, the complexities of making financial decisions and how you need to sort of, I guess, retrain your mind in certain ways to sort of avoid some of the most common pit traps. But Evan's also a strategist at InvestSmart, so I want to sort of talk through, I guess, what we're doing, what they're doing, and where we see commonality, where we see differences, and sort of just explore what it means for assets at this point in the cycle. So I sort of thought I'd start with we're going to start with the book and maybe Evan, you might give us a quick summary, I suppose, of what your sort of why you wrote it and I guess your key messages, and then I've got a few questions sort of on some of the particular chapters that we might be able to dig into.
Yeah. So guys, again, thank you for having me on, and it's an absolute pleasure to sort of sit here and speak to your clients and to those of you that watch your channel. As you said, the biggest thing about money is that it's not about the economics. And my background is economics. I can sit here and talk to you about economics till the cows come home, about why I love it, about why markets are a fascinating thing. But the more and more I've gone along, my other part of my world and my background and my education was psychology and watching what people do. And the two of you know this from talking to clients, that they do things that you go, that is completely against the economics. That's completely against the market theory. Why do they do that? And so that sort of prompted me to particularly the last 5 years, to really go down the behavioral finance route. And I love it. And the reason for it is that it explains so many more, reasons why money is such a visceral thing to people, why investing is such an easy thing to create. And the word here is inaction, because again, people's personalities are tied up with money. Your wealth, your overall perception in the society, your culture, your learnings, your experience, all of that is wrapped up in your money. It's all wrapped up in your investing. And, people don't like to be wrong. So part of the reason why investing is such a hard thing to do is that you need to accept that when you invest, you're going to make a mistake. It is part and parcel. Markets can and are ugly. That's also something I write about very clearly in there. So it's all that put together. And that prompted me to write this about, okay, let's have a look at your mind. What is it about what you do, how you do it, that impacts your, positively and negatively, your relationship with money, your relationship with investing, about the most important thing, according to the American Journal of Psychology is that the most fundamental human thing is autonomy. And I know the two of you at Nucleus Wealth and most people you will talk to, the thing that we use all the time, the term we use is financial freedom. And financial freedom, for me anyway, is the most fundamental thing that you can find, and you can do it. There are lots of ways to do it in terms of how you can do it. Financial freedom for you, Damien, or for you, Sam, will be different to me as well. And for everybody watching and listening, it will be different. And I wanted also to put that in the book. That means understanding things like your biases. Basically, biases are shortcuts. You make 35,000 decisions every day, choices that you have to do. And they're minuscule things to slightly large things, but you do them effortlessly with biases because you've learned them. You know how to behave in certain situations. This is a perfect example. What the three of us are doing right now, we are talking to each other. Although it's through a computer, we can behave and read each other's body languages and know how we talk. That comes into your money as well. So things like what we call loss aversion, which was founded by one of my absolute idols in Daniel Kahneman, who found very clearly that human beings are geared towards loss more than anything. So if you were to find $50 in your pocket, you get a small elation. It lasts probably no more than several hours. Some people might get a day out of it. If you were to lose that same $50, you can actually hold on to that loss problem for a week. And that's what he found in his studies. And he won a Nobel Prize for that study. And it flows through even bigger when you go into investing, because it means, and you look at it from the point of view that you are more likely to concentrate on your lost positions than you are on the fact that your overall portfolio is doing X, Y, Z, which is probably a positive thing. And you two know that from talking to clients. So do I. Clients know that as well. So all of that's where I came with the book.
Yeah, and that's sort of one of my favorite sort of my own personal hacks that I know improves me as an investor a lot is when I try to ignore the price I bought a stock at. So I have a whole bunch of different quant methods that I use to try and work out, is this stock fair value? But a stock that might have fallen 50%, but its earnings have only fallen 10%, I might be looking at that and saying, okay, well, actually, I'm thinking about buying more, but knowing the original price shouldn't make a difference. Whereas if a stock's fallen by 50% and the earnings have fallen by 90%, okay, now I'm selling it.
That's a problem.
I shouldn't be sitting there going, oh, if I just hold on for a little bit, I'll get back to the price I bought it at, and then I feel as if I'm dusted with this.
And the beauty of what you're saying there, Damo, is that you've actually got a structure. So what I want to highlight there clearly is that the way that you're getting around that possibility of your mind taking over your investments is you have a very good structure behind your reasoning in doing what you do. And for those of you watching, if you listen to what Damien said, his ability therefore to go, this is why I did it. I still have that fundamental behind me. It's either working or not, and being a little bit more ability to have some rational thought. Again, being rational 100% of the time won't work, right? Being reasonable will be. And again, listening to what you just said, Damien, that shows very clearly that you're also reasonable enough to go, that hasn't worked. I accept my loss and I walk away from it, because that brings in things like opportunity cost, familiarity issues, all those kinds of things can be sort of circumnavigated with that kind of structure and that strategy. And that's obviously my other hat, and we'll talk about that later. But that is the beauty of listening to what you just said there. And for those of you watching, that's one of the ways you can help yourself get better and be a better investor is developing an investment strategy and a structure to get over your mind's issues that can come with making decisions that probably are against your own personal benefit.
Yeah. Evan, similar to you, I've gone down the behavioral psychology route as well, and studied psychology formally before I came to finance. Yep. And what I've found with myself and other clients as well is a lot of the time people know what to do intellectually, but then when it actually comes to them taking action, that can be the missing link. And I find that point you're talking about with structure, having a plan in place, having routines, having methods to implement your plan. That's what can really, be the difference between people succeeding or failing in the investment journey.
Yeah. So again, further to that point as well. So you look at someone like Harry Markowitz, who obviously invented the whole idea of the modern portfolio theory. And he came up with the risk reward curve that we all know and love, in terms of understanding that basically his theory that he found was that if you find a risk profile for a client and diversify them across, and we'll talk about asset allocation, across that portfolio, they should reach the risk profile they want to maximize, or his word is optimize, their return. So the thing about what they've also found with those studies, and he, again, another Nobel Peace Prize, so that's exactly what you're talking about there, Sam. What he also found, and what the studies have found on top of that, is that when you give a client the ability to go and do a trading scenario or some form of trading game, they will do exactly as they should with what you just said. In that they will allocate correctly, they will make sure that their risk tolerances reach the correct one. It's all done and dusted. The reason for it is that they are guaranteed not to lose. The other thing about it is they're not actually risking anything. As soon as you take them off the game and put them into the real world, they actually break down again. And that's what is so fascinating about it. And I'm glad you raised that, because it's another thing that I love talking about in the book, is that the difference between reality and what is perceived as projections or your own personal reality are always different. And unfortunately, the world reality is the one you need to get into, and accepting that risk comes with it. So that's also what was really interesting, and will be continuing to be interesting about human psychology with money, is that in the structured environment of a simulation what to do, and you do it correctly. As soon as it goes real world, you break down. So how do you get around that?
Yeah, and that's the human emotions, fear and greed.
Yeah.
They're suddenly in play, and things are real.
Yeah. And the other one from your book that that quite like that idea of trying to work out whether you're right or wrong. Sort of most people like to think they're usually right, and I find that the process of actually writing down why something's in the portfolio, because we run a quality value type mix, where we're basically trying to look for a mix of quality and value. And so what that means for me is that if I've got a really high quality stock, I can hold on to it until it gets really expensive. And so I'm happy to go, I put a high quality stock in there. It can move up and down in price. And you know what? I'm just holding on because I'm expecting the returns over time to keep compounding. Yep. Whereas when I put a stock that's say average quality in there, I need to buy it when it's really cheap. And then if it goes up a bit in value, okay, now I'm out. And so it's sort of sitting on a curve, and it mathematically telling me what I should be doing or not. Don't have to follow it all the time. But I find that the ones that are the most why I like to do that and write it down, because the ones I find people get caught up in the most is you buy an average quality stock, but it's really, really cheap, and then it doubles in price, and you're like, great, fantastic, did exactly what I wanted it to do. But no, all of a sudden you start going, maybe it is a really good quality stock. It wouldn't have doubled in price if it wasn't a good quality stock. And you start, whereas you just need to go, no. It's just an average company in an average industry, doubled in price, take my money, go find another one, as opposed to the ones that are the high quality ones, which is like stick it in my bottom drawer and forget about it. And so that idea of writing stuff down to then, so you don't start rewriting the narrative in your own mind.
So I actually come at it from a different perspective too on that as well. So the reason I say that is that this gets back into your personality. And what I mean, I talk about the 5 personalities, and I don't need to go into that. You can read the book for it. But what's so interesting about what you're talking about there, Damien, is the other thing that starts to happen with that is that attachment. Right, so you get attached, and the psychological attachment to it gets so high that you then start convincing yourself that your opportunity costs will be lost if I got out. So if I get out, my opportunity for this 50% increase or this 100% bag that you've catched, that you could miss out on more. And it becomes a physical thing. The way I've always argued it is it even goes back to quality, right? So let's go back to quality. The one, and I know you two get to this all the time, that I remember constantly and still get it today, is trying to tell people to trim their position in CBA, right? CBA is a quality bank. There is no doubt, no argument about that at all. It is absolute quality. But in a lot of people's portfolios, it is an absolute gorilla in size. And you're trying
it's also one of the most expensive banks in the world.
Bingo.
For that
reason. Correct.
Reason.
And price to book, it's ridiculous. Its exposure to Australian residential property is way too high. It is realistically tied up with the Australian economy. So there are problems with it. And I agree with that completely. And then asking them to do that, though, is like asking them to sell their left arm. Like they look at you like you're asking them to literally cleave off their left arm. When you say to them, you probably need to consider about how your asset allocation is and where your position is and your financial freedom for the future. Because the response will always be the same. And I can hear it. I know you two do as well. I need the dividend returns that comes with it. What if it goes higher? It's CBA. I remember hearing clients go, but it's CBA. You don't sell CBA. I said, no. Your money is in a company. It just happens to be CBA. It's yours. If CBA is no longer meeting your overall long-term financial goals, then it's no longer working in your favor. But again, the psychology of selling what is, and in most people's portfolios, their best stock is, as I said, so hard to do. And it's just the same on the other side, is getting in at the right time, or we're not even getting in at the right time. I hate that term. I shouldn't use that. It's more about finding the right opportunity and understanding that opportunity is for the long term. That it's, you then have to find things like, attribution bias. You then look at things that come to attention and why you're buying into it. They also play out in as well. I'm going a bit around here, gents. I do apologize.
No, that's fine. And the other one I liked is the idea that for me is a heuristic I like to use is, okay, if I sold this to tomorrow, would I buy it back the next day? And if the answer is no, it's like, well, what am I holding it for today? And there's actually a fund manager. I'm just trying to think of I've completely forgotten the name of the guy who does it, who actually will literally from time to time, he's a hedge fund manager, so higher turnover, but he will literally liquidate his entire portfolio and then go back, and he might buy back 30 or 40% of the same positions.
Bill Ackman?
But he just
sounds like Bill Ackman thing.
Yeah, it might be Bill Ackman, but he just wants to actually go, no, I just want to make sure I am out of all these, and now that'll force me to actually make that decision. I can try and pretend, but I'm not very good at pretending, so I will actually just sell it. I like to think I've got enough control over to imagine it, but yeah, I find that's a very good one for clients who come to me with often very unbalanced portfolios where they might have worked for a company for years and years and years, and they're like, this is 50% of my company, my thing, and I don't want to sell it in case it goes higher. And it's like, well, if you did sell it tomorrow, would you buy it back on Friday? And they'd be like, no, I wouldn't. It's like, yeah. There's your answer.
Yeah, and another point, sort of taking the opposite side of you, Evan, what you're talking about there, it's people's need to be right. And people can hang on to a losing stock that they know they should cut, but they just hang on to it. They've got this deep need to feel like they've made a good decision, like they've made the right choice. And it's that sort of loss aversion. They don't want to take the loss. They don't want to crystallize that loss.
Yeah, and a self-attribution bias. So when it goes right, it's you've done that. When it goes wrong, it's the environment. So it's the market. It's the market. It's the RBA. It's the housing market. It's the government. It's whatever it is. So it's the environment. So you can actually push off your mistake onto the environment, and that is what, it is very, very strong in our industry, very, very strong in our world, because again, making a mistake with money has a value to it. Like, it physically can tell you how much of a mistake has happened to you. So self-attribution bias is one of the strongest issues in money, is that idea that you are right when you make the right decisions, but everything else is wrong when the wrong thing goes against you. How do you get around self-attribution bias? And Damien, I think what you've already said around your models is a very good way to talk about, getting around that psychological problem. It's also around understanding that you need to go back to first principles in terms of how you look at this. Is this actually meeting my risk profile? Is this actually in an environment that it shouldn't be in? So again, you're right. Do you look at something like cryptocurrency? Do you look at cyclicals? Do you look at a China exposed stock? All of those kind of metrics, whatever you want to use. If they tell you and flash the warning lights at you that this is not the space, then it's not the environment, it's your decision, and you've got to accept that you've made the wrong one.
So actually, I wouldn't mind just. There's one thing on the book I wouldn't mind just sort of. I think it'd be instructive for people. The idea of the 5 different profiles. I know you said
personalities.
Let's won't go deeply into it, but maybe just give us a quick summary of the 5 different types, because I think that was as you said, it's about saying, well, if you're one particular personality type, these are the things you have to look out for versus a different one where you have different.
Yeah, and I also want to say that, as I put it at the start of the chapter, no one of these 5 defines you in one foul swoop, because not only that, you can jump between them. So let me go through them: saver, spender, investor, and ignorer. Now, some people will tell you there's 7. Some people might even tell you there's 10, and that shows you that this is it's not as simple as putting it in 5 baskets. It is on a scale. It's almost on like a spectrum. And why I say you can jump through it, I would argue, or at least I'd like to believe, I'm an investor personality, and clearly talking to you two as well, you are in that as well. It's what we do for a living. But I know full well I can jump into a spender personality like that. And what I mean by that is that I am pretty frugal with what I do. I try and basically make sure that my money's working at every point in the cycle. I hold cash, fixed income. I have property. I have a couple other, I have an investment property, and I'm very open to talk about it. But what I mean by a spender as well is that if I was to go out with the two of you, I am more likely than not to offer myself as the first round. In fact, I may even offer you for the whole night. But that's my personality, and I know I shouldn't do it. Right? I know
for the whole night, really.
Well, yeah. So
that's right.
Let's go out.
Yeah. Because again, it's sort of my money in terms of the way I find my lifestyle and the way I enjoy myself is to go out and have experiences. Now, I don't do that very often, and that's the other thing. So I know I can do that. And again, I am a net saver, so I have that in my back pocket. But this is what I mean by you can jump through the personalities. But going back to them, the interesting thing about them, they all have their pros and cons. So, for instance, the saver, I think, is one of the most interesting ones because savers are those that are looking for sales. They're those that probably actually have an incredible amount of cash. They will have almost zero debt. The reason they're so interesting is that they actually are the ones most likely to see money as a physical thing. Like they are the ones that will probably be on their mobile phones these days rather than their wallet and actually bring up their banking app and going, this is how much money I have. And I can see it. I can physically see how much money is sitting in my bank. And I like seeing that money number just get bigger. And telling them to use that money is the same as what we were discussing before, Damien, about trying to tell them to use their CBA funds. Savers are very interesting people because they're ultra conservative, but they're also the kinds of people that will let opportunity pass them by. They're the ones that also are likely to call you on the mistake, right? So if you do make an investment, they're the first people to call you on that because, again, money is a physical thing, and to see it lose value to them is something they actually, personally can't take. Spenders are pretty obvious in terms of what they are. Spenders doesn't mean that they go into a level of debt. I'll come to that in a minute. That's what a debitor is. But spenders like the finer things in life. Money is easy to them in terms of what it is. It's just a vehicle to get to what they want to do. They will buy the newest things, but they also therefore don't have the ability to probably take that next leap in their financial freedom. They don't have that sort of ability straight away to possibly go and buy a house or to go and buy something that is an asset that requires a larger amount of fund backing. Debitors is the one that I think if you do know a debitor, they are the ones that need your most help. They are the ones that unfortunately tend to live paycheck to paycheck. They are living off a scenario where the debt on offer will be a much higher interest because they are a liability, unfortunately, to the institution. And they also can't understand how people can get to a scenario like an investor or a saver where they have lots of disposable income. They're the ones that I like working with because they're the ones that I feel like can help. Because if you can help them get away from that's the beautiful thing. Go on, Damien, you're going to say something.
I was going to say that's a great description. Was that as a debtor, you get to live one glorious month while you run up your credit card bill, and then you spend the rest of your life trying to get it back to zero.
Trying to get it back, and they're jumping through them. They're jumping through them. I'm not going to go through an investor. That's pretty obvious. Investors can become debitors because they can speculate. So that's the other thing about an investor. Do not believe that having an invested profile makes you some form of absolute financial genius or financially freedom. Be aware, a lot of investors like to start taking a level of assertive risk, moving towards aggressive risk, can find themselves in a lot of trouble. The one that's also interesting, and it actually makes up the majority of the population, is the ignorer, sometimes referred to as the ostrich, because they stick their head in the sand. They actually genuinely don't care about finance. They just don't. They will literally go through life not looking at what they have. They know they're making super. They don't know what it is. They know they get an income because they can go and spend, but they don't really do that. And they're more likely than not to not pay any attention to anything going on in their finances. They're more likely than not to allow it to be done by someone else. They're going to dole out their actual running of their own personal finances to other people. And they're the ones that I think if you can reach them, they could be an incredible group of people because once you are slightly engaged with your finances, again, as I said, autonomy comes very quickly with financial freedom. And those ignorers are the ones that probably don't realize they could find financial freedom very quickly if they just spent 5 minutes a day paying attention to their finances.
Yeah,
Now,
and Evan, just to your point about the 5 personalities and how you can switch through them, I think that comes back to values. And you may value saving and investing, but you may also value experience, like you said. Yep. And it depends on the context and what you're valuing in that moment and what's most important at that time. And I really think in financial planning and also in finance, particularly with the rise of behavioral finance and behavioral psychology, is there's this more infusion of values into money and the understanding of the impact of your values and how people spend their money. Because in the past, financial planning, it was so product focused. And it was just about this product with no sort of real understanding of the why behind that product or, what's most important to you. So, yeah, we're going to plan for these things in your life because you value that. And I think, that evolution, that's what really good financial planners do these days. They not only focus on the money aspect, but the values behind the money and why it's important and gear the plan and everything around that.
I want to change tack a bit now. So I want to sort of jump to some of the more market-based things. So Evan's also, strategist at InvestSmart. Have I got that?
Yep, you do.
Right, yeah. So so there's I'm going to drift in a few different directions, but I guess I'm going to start sort of as a bridge from what we're talking about is I think it's Morningstar has sort of a investor survey out there and sort of says, well, the average retail investor tends to lose about 2% versus the market because of bad timing decisions. So they tend to get excited when the market's just gone up 20%. They're like, oh, it's a great time to invest. Market's up 20%. I'll pile in, and the market's just fallen 20%. And it's like, oh no, things are terrible. So I guess I'd come back to you. So from the way you look at things, are you looking at current conditions as an opportunity? Do you think people shouldn't try and sort of lean in as much? They should just accept average in. How do you sort of approach it from a sort of a strategic asset allocation point of view?
There are so many adages I could put into that. Like that question is basically, timing market, dollar cost averaging, lump summing. Okay, so yeah, in short, the way I look at it is this. Strategy is absolutely key to this. And Damien, you've already said a lot of what I would actually confer with regards to my main day job being strategy, which is have a structure, stick to your strategy, know your strategy, and if you've got models, you stick to them. Almost come hell or high water. First answer. Second part of it. Okay, let's look at right now. So why right now is so interesting is I actually think the market is testing the idea that we're at the low. And so coming back to first principles and coming back to market theory and back to economic theory, markets are always in equities, at least under theory, trying to price in what 12 months from today looks like. So what does November 2023 look like? And the reason I ask that question and why I think the market's testing that bottom, will inflation have peaked out? Probably, from what the the economics are telling us. It's, in my view, the one to watch is core inflation still rising, so that concerns me a little bit. Will the rate cycle across the globe have peaked? Yes, that I think is clear. The US Federal Reserve, in my view, will probably peak out in about May. It will be tough. It'll be hard. Will they leave it there for a while? Yes, I think they will. So all of that is there. Then the dreaded R word. Will recession in the US be confirmed? I think it already has. Like, if you look at what's already there, I mean, technically, they're in a recession. I mean, their first and second quarter of this calendar year were negative growth quarters. So that's under economic theory, a recession. Over in the States, they confirm it differently. They have a board that actually then tells you, yeah, we're in a recession. So
it's late though as well. It's like it's not we are in a late recession. It was 6 months ago.
It happened. Yeah, it was back there. So you see that stuff over there. That happened. That was real. And the reason I highlight that is that if you go back through the late 70s and 80s, because this is, I think, where we're comparing to. So stagflation, not really going through that, but there is some deal to look at the 70s. But in my view, the 80s are the historical numbers you can look at, where you look through 79 to 82, you look through 83 to 86, and then from 87 and 89, where you had all these sort of periods of high volatility, inflation problems, high interest rates. If you look through them, particularly through the 79 to the 81 and the 82 through to the 85 movement, the upside was incredible and was missed by most. So the markets in the States, for example, fell by about sort of 15 and 20% in those two periods that I just described. But the recovery on both times was about 35 to 40% from the bottom to the top. And the one in 83, 85 was incredible because it went 25% and then did another 25%. So first, back getting the original question, Damien, in terms of how I look at it, is timing the market is going to hurt you because you're never going to pick the bottom or the top. Time in the market is going to help you. So dollar cost averaging is what I'd be doing right now. Back to your idea about where we are, I actually think this time next year, things are going to start actually to grow. And I think the market is realizing that. I'm not saying it's the bottom. I want to point that out very clearly. I think the next 3 to 6 months, volatility will be up and I could be proven wrong quite quickly. But, and it should be put out there quite clearly as a but, there will and already is showing signs that companies will be able to recover through 2023. And 2024 looks quite interesting. It actually looks like a period of, the unemployment rate in the States and here in Australia will rise, but not to pre-COVID levels. As in, it's not going to go, in my view, to sort of 5.5 to 6 here in Australia and just couldn't get any lower. It's probably going to get to about 4.5 to 5. And that means that when we come out of that problem and there is a little bit more financial freedom with regards to economic policy and monetary policy, the growth will be quicker because there'll be more people employed. So that's my very, very long-winded answer to your question, is that I actually think the market is testing that right now, because since the bottom of October to where we're up now, we're up 7.5%. It's trying to ease off and it's finding buyers. And I find that a very fascinating thing.
Yeah, we've actually got a viewer question that's very, very on point to what you're talking about there, Evan. It's from Umbers. He's saying sentiment is supposedly at record lows, but there's been no run for the exits. Is this typically how we get primed for a crash? And he says it seems like a bit like September 2008 at the moment.
So, yeah, okay. So the GFC is an interesting one, and I understand that's, front and center with people's minds. Is this a comparison to GFC? I personally think it's a little bit different. As I said, I think it's more like the 80s. And as I said to you, I could be proven wrong very quickly with my answer to what I said. I'm very cognizant that the US is still in a bear market, right? And is this a bear market rally? There's certainly signs that it could be. The other thing to you is your point, Umbers, is around the view at the moment that sentiment and action are completely polar opposite. So you look at spending in Australia and the US, it's mental. And what I mean by that is that consumer confidence is at or near record lows. So it's lower than it was in the GFC, not as low as it was at the peak of COVID. So it's not far off. Spending, however, is still 12% above pre-COVID levels. So even with 7 months of interest rate rises here in Australia and actually interest rates in the States rising for the last 11 months, it hasn't reined us in. So that sooner or later is going to have to come home to roost. I get that. And that's why I'm slightly hesitant to answer Damien's question by saying, is this the bottom? I put my hand up and say, I don't know, but I think the market is testing that theory to try and work out if it is. And at the moment, for the last 6 weeks, it's been proven that maybe it could be. Again, what happens over the next 6 weeks, to probably more likely what happens in January, February, will answer that question much better than I can speculate.
Yeah, because I guess we've taken the view that, look, it's probably a bear market rally, and the I guess the basis we're looking at that is valuations are no longer expensive, but they're not cheap. It's no longer like we hit sort of record level, not record, but pretty close to record levels of how expensive it was. That's come out of the market. It's cheap. It's certainly not cheap. No, it's above average still. But earnings have actually have held up really well. And so, and this is where I guess the part for me is, well, if company earnings are going to get a hit, then there's more downside. If they're not going to get hit, then then maybe we can sail through this. And that I guess the two sides I'm looking at of that argument is.
So my question for you on that, before you go any further, my question: do you have any sort of what I call canary in coal mines? What stocks do you look at, or what sectors do you look at as the canary in the coal mines to answer that question?
Yeah, certainly. So a number of so housing sector one is a big one, just because I think we've become the housing market's become so financialized that in most countries that this run up in housing prices and run down and the construction and how that echoes through the economy. Some of the cyclical, more cyclical sort of capex sectors. I think Australia is actually quite difficult in that sense, in that the mining sector can be out of sync with other ones, and we've also got the energy sector is obviously going through massive changes, all the issues with Russia. So they're sort of throwing a few things out of sync. And so there's going to be some echo effects of that. There's going to be more capex in that sector than you would ordinarily have in a normal market sort of downturn. But there are other sectors, sort of more industrial type sectors, where you're sort of looking at the amount of capex, and I guess there's been so much money spent, say in the transport sector, on trying to clear a lot of the backlog and things like that. Is now, do we get the benefit of that? So do we come rushing out the other side in that? Okay, it was. I was having problems sort of getting enough stuff out. So now I've doubled my capacity to process whatever boxes I'm processing, just as actually volume of goods fell by 30%. So actually now I've got excess capacity and I'm trying to fill that and go into sort of deflationary.
Do you want to jump in? So I'll jump in there because I think that's sort of pretty much what I look at. So getting back to your construction point, from a macro perspective, which is where I tend to come from slightly with my strategy, is I always watch the employment levels of tradies, right? So the construction industry is a beautiful microcosm of cyclicality of economics. The reason for it, tradies are the first in and then the first out. They're also the ones that are paid very well when they're up, but they don't get paid at all when they're down. So they're a massive, massive provider of stimulus for discretionary, a massive spender with regards to that feed in with those kinds of areas that also are cyclical. So construction work is another part. James Hardy, I think, told you that this week, right? So they're telling you very clearly that the fall in the North American business is something to be very cognizant of. Next one's lumber. So I actually follow lumber for a good reason. So you get there about supply. Why I picked you up and why I wanted to interrupt you was that here in Australia, last year we had an incredible issue with lumber across the globe, but Australia as well, where we had the slack that was in the market pre-COVID just disappeared, and it was massively undersupplied. It's now oversupplied. So structural timber in Australia has gone from about $10 to $11 a lineal meter down to $5 to $6 a lineal meter right now. So that also tells me that there's a squeeze on in that space. And that's sort of where I look at. So I get the question.
I do like that one, but I found that was very volatile. There's a lot more volatile than you would have thought. Certainly the US ones, anyway, over the last sort of 2 years. It sort of it hit almost 2,000 and then back to 1,000, back to 500, and then back up to 1,500 again and back down. Yeah.
Hope that answers the question that came in for Umbers in terms of that, because that's a great debate. And there's a lot of things there.
Because the other side of so I guess I've talked about that. This is the part where the transport side is the microcosm of somebody who's done the investment, and we end up with deflation. They can now do too much, and so now they're cutting their prices, trying to they spend all this money on capex to expand. Now they need to fill it as much as they can. But the flip side is, I feel as if there's been a lot of companies out there who have got pricing power because everyone else has seen inflation. So I don't know if you're a Netflix or someone like that. Is like, well, has your costs really gone up that much, or are you just putting your prices up because you got a chance? There's inflation. People are accepting of inflation, and so it's a question of there's companies with pricing power who have managed to get through price rises they might not have otherwise done. And if they haven't got the competition on the other side of it to force the prices back down again, will that stick for a bit longer than it might have done?
That's the Buffett rule. It's the Warren Buffett rule. In terms of what you're talking about there, is that what he looks for is the company that is basically the pricing behemoth and can do almost whatever they want. So the one I would probably point to there is CSL. You could also point to Woolies and Coles, because they have that ability just to force the price upon you. And so I completely agree with that. That's what he does. That's what his mantra has been. I mean, it's why he's always said that something like Kraft or Heinz or Campbell's have been incredible for him. His biggest ever investment was Hershey's, the candy maker over in the States, because they were the only one out there. And he basically, that company had complete and utter control of the entire market, and he could do it. He could almost manipulate it from price perspective. So yeah, those things are great. So what I'd also look, and getting back to my slight differences, is that when I'm in these kinds of environments, because the question I always get is, what do you do in high inflation environments? I said, well, then you just go back to essentials. And what I mean by essentials is that there are non-essentials and essential items. Essentials: health, education, transport, food, energy. Those 5 are things that human beings realistically can't do without. And so they're the questions that I think a lot of people are going to have to start asking themselves about. What I mean by that is that for the first time, particularly if you're under 45, who have never had inflation issues in your life, will have to make a decision between those 5 and going on travel, a construction of your house, a renovation of your house, because pricing has come to that point. So getting back to it is that you look at the 5 essentials, and they're the ones that can get through high inflations much better, because you're still going to have some form of customer flow at all points in the cycle into those essentials. And they're the ones that tend to do quite well in high inflation environments too.
I mean, the consumer staples sector traditionally often actually sort of rises, and that's when you're talking about what am I looking at as canaries, because the other one is consumer staples sector traditionally. Look, if you look back at the last few recessions, they've actually managed to grow earnings into the initial stages of the recessions as people sort of downgrade, I guess, what they're, they go from eating out to buying more from Woolworths or whatever, and but this time they've actually been a little bit weak. So that's sort of one area where
So my question to you on that is that I wonder if it's because obviously part of their cost issue is transportation. So the energy thing that you were talking about before, Damien, comes right into it. They're having to suck up the issue around diesel and the diesel transportation industry. They're having to suck up the incredible inflation that's coming from the climate change issue of floods and fires, right? So whether you agree with me on that or not, those watching, that's fine. But you can listen to Brad Bellucci in terms of what he's saying out of Woolies, is that normally they'd probably put that through, right? They would take that cost and put it through. And I think the market has been aware that they're doing go back to the 2020 slogan where you had, doing it for the country, where the banks were told to obviously try and take a bit of a haircut around, bad and doubtful debts and non-performing loans, and not putting them under the pump as people were in lockdown. I think the same thing's slightly going through right now with, your staples, which I agree with you is out of the norm. Normally in this current idea, the price would come through. So you go back to, Hurricane Edna, and for someone like obviously Sam, who's living up in Queensland, watching cyclone season is always interesting. So bananas are the great example here. So back in 2011, bananas went from $5 a kilo to $15 a kilo because 95% of our plants got wiped out. Coles, Woolies had no problems in handing that through to you. This time around, it's not the same, which is interesting, even though it is going up. So, you can make the argument about, what's happened with the floods. It has come through, not as dramatically as we've seen in the past, not, almost exactly dollar for dollar change. It's just been passed straight through.
Now, I guess if we switch to talking a little bit about international stocks. Now, I guess I've got what I tell investors is, look, if you want to hedge your currency right through the cycle, then you're throwing your money away. It's basically because the currencies go up and they go down and they come back up again, and if you're going to hedge right through the cycle, you're basically adding an extra cost, an insurance cost over the top.
I agree.
And so there's an element of leaning in, and so when the Aussie dollar is at parity to the US dollar or 80 cents and above, is like, okay, now I'm looking for opportunities to take advantage of that, and it helps actually cushion some of the volatility as well. But on the other side, when you're more confident that the Aussie dollar is bottoming and it's got a 5 in front of it, then now you're talking about hedging. Do you do you guys hedge international? Do you leave it unhedged? What's your sort of?
So we, exactly as you just said. So we look at that all the time. And the reason I say that is that international investing, so I actually want to go back even further. And before I answer that question from what InvestSmart does is, the studies out of the ASX themselves show very clearly that Australians, unfortunately, are underinvested overseas, right? So thankfully, it's getting better. So about 4 in 10 now invest overseas. But when you look at those 4 in 10, their holdings of international equities in their overall portfolio is averaging about 2%. So that is first and foremost something that we need to address, right? That we are, the reason I say that is that if you look at international, so if you look at the MSCI World Index, excluding Australia, so taking the ASX or the All Ordinaries out, on average, over the last 15 years, that index has returned about 10.5%. The ASX is about 9.1. So there is an outperformance that comes with international equities. The catch is that they are more volatile. So this is the pro and con, right? We are a value market here in Australia, and Damien, you can hear that very strong in how you talk about equities, and that's good. Value has an absolute place in your portfolio. The thing is that it also causes an ability to probably miss out on growth, and growth has been a killer for value investors over the last 15 years. So the next thing,
and the other one is you're an extreme sector exposure that we always talk about, is saying, you know, if you were a US advisor and you told somebody, I recommend I recommend within your portfolio you have 40% banks, 25% resources, and one
popping up with energy, and then having the barbell in the middle.
One big energy company, one big healthcare company. You know, you'd be. And that's your portfolio for your client. You're at risk. You're liable for damages. But
you and I would be packing our boxes and walking out the door because you get a tap on the shoulder going, "What are you doing?"
So and I think one of the things with Australian shares as well is the dividends. You know, you're getting a large part of that return in the form of dividends, and people really like the franking credits. You know, the retirees that are getting the full refund.
Right? So that's a beautiful point to raise. And the reason I say that is that the Australian market, again, some people can test me on this, on a grossed up value, right, is the highest dividend paying developed market on the planet. There is nobody even in the realm of where Australia is with dividends compared to the rest. Now that is my view. Again, this is my view. Part of the reason we underperform, because it does not incentivize growth. It does not incentivize companies and boards to take decisions that are actually in the interest of the company to grow, rather than the whole idea. Now, the point back at me, you should be doing everything for shareholders. I get that. Dividends are the profit the company made that's should be reinvested into it. So again, my argument would be CSL. CSL until about 3 years ago was my beacon to go, look at a company that puts research and development at the heart and soul of what it does. Right. At one point in 2018, it put $1 billion back into itself in R&D. Right. That is growth. That is why CSL is now sitting third largest company on our ASX. Yeah. If you look at the banks, they just don't do it.
Yeah, and I think, sorry, Damien, just quickly, you know, it's
sorry, I stoked something there.
This is incentivizing. It's not incentivizing the companies to reinvest in themselves.
Correct.
But it may be incentivizing investors to have that overexposure to Australia with that home bias because they're getting the dividends.
Yeah. But again, the question there is that if you look at the return that comes with that, okay, yep, compound interest plays an absolute massive part in that, and I completely agree with where that is. But again, if I go back to my example about the World Index ex-Australia versus Australia, that 1% difference over 15 years is a 20% difference in compound interest over 15 years.
I mean, we all work in finance. We understand the power of compounding. And we know total return is more important than dividends. But I think the dividend, it might be a behavioral psychology bias. People like to get that income into their portfolio, into their bank.
It also means they're not having to lose anything out of their nest egg, right? The nest egg is just paying them under here, right?
It insulates you from any market losses, you know, rather than just having the capital value. You know, you're sort of insulated from the income.
My self-managed funded retirees, I'm really sorry that I'm rubbish.
Now, I did this analysis a couple of months ago. I put up a blog post on it. Actually, no, it wasn't. Yeah, August. I did this in August, so I haven't updated the numbers. But basically, my take was when you look at the where you're getting your dividends from in Australia, most of it's from the materials and the energy sector.
Which it
now,
just shouldn't be.
Well,
Barbells.
you're not, if you're buying BHP for
dividend.
the dividend yield, it's the wrong thing, because they're happy to cut their dividend to almost zero if things go wrong.
Yep.
And
they
so,
will very quickly. I mean,
Yeah.
I've interviewed David Lamont, who is the CFO, and you can hear it in it, right? The reason he's giving his money back to people is because at the moment, BHP, because of
Nothing
what
better to do
Damien
with
said at the start, because as you said at the start, Damien, they have similar models, right? And they're running their ruler over everything constantly to try and find tier one. They will not invest in anything else but tier one assets that are at a reasonable price. And what he was saying is that at the moment, nothing is at a reasonable price.
Yeah.
But it's
And so-
there. And as soon as he can, you watch him put that money to work and that dividend gone.
Yeah. And so that sort of leads on to two parts. One is, if you just took the Australian market and you said, rather than, because there's so much of it resources banks, rather than invest in the Australian market in the weights that it is, if you said, I'm going to invest in it into the size that the sectors are internationally, so you'd put less than 10% into banks, you'd put 3 or 4% into resources, and did it that way,
or
you would
10%
halve
into
the
IT,
Australian,
or 20% into IT if you look at the S&P.
Yeah, but you kept it in Australian stocks. So you bought Australian stocks. You don't buy any global ones, but you just use the sector weights as international. That would halve your dividend yield. So effectively, the reason why you're getting such a high dividend yield in Australia is because you've chosen to invest in resources and banks, which which are currently paying high dividends.
Yep.
And then the flip side is, then you go, BHP on its own is giving you about 0.5% of the Australian 0.5% increase in your Australian dividend yield. If BHP decided tomorrow that they're going to re-domicile to London and like Rio, and so they're no longer an Australian stock, would you actually go out and find 15% more resources to put into your portfolio so you can keep your dividend high? I would thought most people would go, no, that's crazy. Why would I do that? I'm overweight resources.
Find a company outside of BHP that's going to give you that, right? So if they were to leave, right, and you look at the rest of them, you're then moving down the scale. So you then start going, Fortescue Metals, can they continue to pay the kind of dividend they're paying? My argument is not. I mean, the sort of the shooting star that has been iron ore is starting to ease off. Those additional incomes that they've been getting. I mean, still 95% of what Fortescue does comes from iron ore. That's not sustainable. Then you work your way down, right? Then you're going right down the scale in terms of the next sizes in the material space. And you're then starting to look at companies that are more cyclical / growth. You're starting to go towards nickel miners, copper miners. Then you get even more speculative. You're going down to things like lithium and everything else in between. So, you look at South 32. Is South 32 going to pay you a huge dividend? I doubt it. So I agree with that concept.
Yeah. So at the moment, are you guys hedging or not hedging? Sorry.
Getting all the way back to that.
All the way back to where we were.
All the way back to that original question. So again, the cost of it is showing that it's not worth it. So no is the answer. So right now, because we get that question a lot, if you look at the cost, it adds around about 0.7, even as bad as 0.9% per annum in costs. And in the end, fees are a massive killer on your overall return. And it is a level of fee that we don't think you need to swallow to offset the issue around the currency. Because again, the currency swings and roundabouts can be made up very quickly. They can also be made up by the returns just in the market itself. So we understand the issue, we understand the hesitation, but right now, I think trying to play a hedge, the cost just does not stack up in terms of what it does.
And is there an Aussie dollar level where you'd sort of go, I mean, I guess, assuming that, that there wasn't suddenly major economic problems for Australia, but, I guess where I go, well, if there was a 4 in front of the Aussie dollar, sure, I'd probably be hedging most things at that price. If it's in the 50s, I don't know, sort of depends upon how far through the recession we are, but I'd certainly be thinking about it. And even, low 60s, low 60s a long way through a recession.
And go back to one of the questions I answered before about thinking about what November 2023 looks like. And the reason I say that is that when we talk about the Aussie, obviously we're talking about pair, right? So realistically, you've got to think about the US dollar. And at the moment, the US dollar is king. It is absolutely monstering everything. I mean, if you think we've got a problem with the Aussie, have a look at what the Europeans and what the
emerging markets,
and what the British are going through at the moment with their, I mean, you look at cable. So sterling's been absolutely through the ringer. You look at the euro's below parity, right? We're talking about a euro here is 97 US cents, right? A currency that normally is about 112 to 116 is below parity. And this is all because at the moment we have high volatility, inflation issues, a US Federal Reserve with levels of rates we haven't seen in decades, and we've got safe haven transfer. So it's all flowing one way. It will unwind. So the bounce back in the Aussie could actually be quite rapid to more a fairer value that could be more about 70. I don't actually think it's worth more than 70. I actually think there's some other fundamental issues around the Aussie. But what I'm saying to you is that, again, yes, if it was to fall to 40 cents because of a geopolitical or a GFC style problem, but again, the risk about hedging is that if it goes the other way, you've then got to unwind it again, and the costs involved with all of that probably doesn't stack up at the moment, in my view.
Okay, so just aware as well of time. So relatively quickly on bonds. Yeah, my problem as well. There's bonds. So how are you guys treating bonds at the moment?
So again, this is a great question, and we will see.
Sorry, can we go in two parts? Can we go corporate bonds and government bonds? So we start with government, maybe.
Yeah, let's go with government, because I think that's sort of where there's been a lot of talk this year about bond vigilantes, about is this the end of fixed income? The way that people fund, etc., is coming to an end. It's not. Let's be honest. I mean, bonds are a fundamental part of the liquidity provided to global markets. They're a fundamental part of how governments structure themselves and how they fund themselves. So it's not going away. The other thing is that the way that we look at bonds at the moment is that you're getting incredible discount to face value. And I think that's sometimes lost. We forget that the reason fixed income is different to cash, going back to fundamentals, cash, so this is things like term deposits, etc., does not have a capital price movement. So it cannot appreciate or cannot fall. At the end of it, you get your exact same principal back and then the interest earned. Fixed income does have a capital component. And at the moment, that's trading at a discount to fair value, to face value. So in Australia, face value is $100. It's the same in the States. And a lot of bonds at the moment, because they've been sold off so heavily about raising rates, is that they're trading it between 10, 13, even as much as $15 off their value. So particularly if you're a medium-term investor, this is at the front end of the curve, as we call it. So you're talking about 1 year, 2 year, 3 year bonds, which are not that far away. If you're somebody that's looking for a medium-term view, you can be getting that $13 in 2 years' time, which adds to your overall yield, and they're about 4.5%. So that is a very good return on the ASX normally per annum when things are normal, right? So a 4 to 6% return on the ASX is good, let alone getting on a bond that is done on a sovereign level. Do you think Australia is going to default? No, even with things going haywire. So from our perspective, bonds, we actually think they are something that you should be attracted to some extent, particularly if you're a conservative investor. I know if you've been in them this year, it's been hurt. But if you go back over the last 5 years, bonds in 2018, 19, and the start of 2020 were doing completely abnormal things. They were appreciating about 8 to 10% per annum. And I remember sitting there just writing constantly to many clients I could, saying, this is abnormal. Do not expect a bond to give you that kind of return per annum. There is a clear fundamental problem in the market because things at the time were driving you towards bonds. Now it's the other way around. And it's just correcting itself, in my view, and actually smoothing itself out. So in answer to your question there first, Damien, sovereign bonds, I think they're actually becoming more and more attractive if, and this is the if, you are holding to maturity. I think you will probably find there's still a bit of volatility. Rates are going to rise a bit further, and they could get slightly cheaper still. That's fine. That's okay if I'm holding to maturity and I'm getting that difference.
Yeah, and exactly, and you're high enough now that the yields are high enough now that you're like, well,
I can offset the $2-3 that might come out of it a bit further. I completely agree.
Yeah.
Corporate bonds are a bit different. So corporate bonds at the moment are interesting. It depends on which ones you want to look at. Okay. In Australia are done as hybrids, right? So let's put that out there. For those of you that don't know what hybrids are, the banks are very good at using this. They use it as a way for their CET. The reason they're a little bit interesting is that they can be converted into equity. They can be converted into other things. They can be early converted. So there is some caveats that come with them, and they are tied to the bank bill swap rate. So they're quite attractive because, the BBSW now is what, 2.85%. Some of them are offering 300 bips over that. Some of them are even as much as 5 bips over that. The catch with that is that those corporates now are funding those notes 6.5%, 7%, which means they're either at neutral or possibly making a loss on that, because they're probably likely a bank, or more looking down the scale. You look at an insurer like a Suncorp, or you look at an IAG. Those kinds of guys are using that difference to then go out to lend. And so they're going to have to raise lending rates, and you're therefore putting pressure on your lenders. And that makes me a little bit nervous. So I'm not as excited by corporate, because I think corporate's the one that's going to feel the pressure of interest rate rises, and they're the ones that can actually lead to issues and possible, inverted commas, haircuts. Touch wood, it doesn't happen, but that is my concern with corporate bonds.
And the other one I always hit up people with is, because so much of the Australian corporate bond market is banks and insurers, and so much of the Aussie equity market is banks and insurers, and you probably own a house as well, and the banks are loaded up on that, and you can just sort of see people who come out and go, they go, yeah, I've got a nice diversified portfolio, and you're like, no, you've got 6 different flavors of Australian housing exposure, from one to the next. So, and
you're just basically trying to gear yourself up on a dividend yield, and that's probably not the best idea either.
Yes. Excellent. So, well, is there any, we've taken up heaps of your time. I really appreciate you coming on. Is there anything else we should have missed?
No, I don't think so. It's been a great debate. And what I want to say before you guys finish up, thank you so much for having me. It's been an absolute pleasure to be here. I've loved this. This is what I love doing. I love coming in and talking passionately about finance and why it is such a brilliant thing for your financial future and your financial autonomy. It's something I believe really strongly about, and you can hear it in the way that the three of us talk. So thank you so much, guys, for having me and inviting me onto your program.
Thanks, Evan. So now we have our viewer question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, when do you think we're at the market bottom? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. Evan, just before we wrap up, I'd just like to give you an opportunity to talk about your new book and just let the listeners know where they might be able to get it.
Yeah, so for those of you that are watching live, here it is here. Mind Over Money. It's now out in all good bookstores, so you can buy it online, Amazon, Booktopia. It's in anywhere that you can go, Big W, etc. It's been an incredible process to do this, because I actually think this book's taught me a lot as well in terms of me trying to hopefully give it to you. So thank you guys for letting me talk about it. If you do go and buy it, thank you so much. I really hope you enjoy it. It's been a pleasure to bring it to you.
Amazing. Thank you so much for coming on the show. It was definitely a lively discussion, and all the best with your new book.
Thanks, guys.
Thank you. And Damo, thanks again for putting on the show and sharing your amazing insights.
Cheers, Sam.
Excellent. So we do welcome your feedback on this podcast, especially in relation to ideas for new topics. If you do have an idea, please drop it in the comments section below, or send us an email to contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal financial situation. If you do want to discuss your personal situation, please go to our website at nucleuswealth.com/contact, and you can book a call with myself. Don't forget to like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content, or subscribe to our homepage for our weekly Nucleus news and investment insights. We do put out a lot of articles and videos in addition to the podcast. And of course, you can follow us on all major social media. So for myself, Damien, Evan, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.